In today's video, I'm going to be going over how to survive the upcoming apocalypse, according to Ben Kinney. This was a recent article that just came out. We're going to break this article down. Give me about 10 or 15 minutes in this video, and we'll get through everything, and you'll have a good idea whether you're an investor, buyer, seller. You will know how to survive the next 6, 12, 24 months. So this guy, Ben Kinney, this guy right here, he just came out in an interview basically talking about how to prepare and survive the apocalypse that is coming up. And a little bit about Ben Kinney, because you need to make sure you're getting your information from the right people, because anyone can say the market's going down, up, this or that. Ben Kinney owns the Ben Kinney Companies, very original there. Multiple Keller Williams brokerages and Place. It's kind of like a technology firm that works with agents. And that technology firm is actually valued at about $1 billion as of now, owning multiple Keller Williams franchises, and he also has this training company. So this guy kind of knows what he's talking about when it comes to upcoming recessions and that type of thing. You can see here his little side hustle just achieved unicorn status with a valuation of at least $1 billion. Pretty impressive. And less than a year later, he's still expanding and looking for new opportunities despite a market that looks very different now compared to 2021. And that's a good lesson to learn right there, is that a lot of times when there's hesitation or a downturn in the market, there can be some great buying opportunities and great opportunities for expansions, acquisitions, different things like that. Okay, so to start with, how is the market doing and what are you seeing from your vantage point? I think the experts, the investors, the private equity, venture capitalists believe there is a 100% chance that we're going into a recession. Just 100% chance. And he said, from my perspective, that isn't necessarily a bad thing. As a real estate professional, I've been asked for years, is the real estate market good? And my answer for many years has always been, it depends on who you are. For the last 7 years, it's been really great for sellers. And for the next 3 years or 2 years or 4 years, it'll be much better for buyers. Maybe it'll be much better for buyers. It's that in-between time when markets are shifting, when everybody tends to freeze and do nothing. And that can last a month or it can last a year. And that's what we're coming to. That kind of eye of the storm where it just feels like nothing is happening. And a couple things to add about that. Yes, for the last 7 years, it's been great for sellers. It's been amazing. If you're a seller, you check your Redfin estimate every, well, for me, I like to check my Redfin estimate every couple of weeks. And I've just been seeing it go up and up and up. However, real estate is obviously cyclical. It's never not been cyclical. So it goes up, it goes down. Over time, over the long horizon, yeah, real estate prices tend to go up. But it moves in a cycle, and we're nearing the end of this cycle and moving to a new cycle. And when markets are shifting, when there's uncertainty, this can actually be great buying opportunities. I just recently looked on the MLS. I almost purchased a property on the MLS, got another great deal on the MLS. Within the last few weeks, I've seen some really amazing opportunities on the MLS where people are not paying 50K over, 100K over. The market has flattened out and it's starting to actually go down. We're seeing a lot more price drops. And, this, with all this uncertainty, with interest rates rising, it can be a great opportunity to find a good deal. And if you're a seller, it also means that you need to go all out and do everything possible to make your house look perfect when you go to sell it. I'm about to sell one of my duplexes, and I'm going to price that thing to sell. I'm going to do all the curb appeal. I'm going to try to make it look like the nicest house in the neighborhood. You can't just, throw your house on the MLS anymore and expect it to sell in 2 days with like 10 offers and 50K over asking price. You actually have to do some work, believe it or not. He says, I believe interest rates are going to peak over 7%. Right now, I think they're at about 5.5%, maybe 6.5%. Affordability is at an all-time low. People are going to be looking up for a while and say, I don't know if this is a good time, and will be worried about a price decline. If interest rates actually get over 7%, there's going to be a lot of people that are going to be uncertain. Even when it hit over 5%, over 6%. It was just recently, it seemed like, where interest rates were like 2.6, 3.5. In that range, and now all of a sudden they're basically double. Prices have skyrocketed, and you're seeing a lot more price drops and price declines. Now, before we go any further, if you're a real estate agent or real estate investor looking to find consistent investment deals in terms of multifamily, small multifamily, flips, long-term buy and holds, whatever it may be, reach out to me in one of the links below and book a quick call with me so we can have a chat and see if it'd be a good fit to work together. I do one-on-one investing, mentoring with different agents and investors nationwide. Currently, I own 5 multifamily properties, and I also usually have a flip or two going on here and there. So I'd love to have a quick chat and see if it'd be a good fit. He then goes on to say, and then maybe in 6 months or 9 months or a year, people are going to look up and say, I'm still making babies, I'm still getting married, I'm still getting divorced, I'm still changing jobs, I still want to get out of this state and go to that state. And real estate will start to move again, just like it did in 2009, 2010, and 2011 as it started to change. And it was during that period that actually literal fortunes were made. If you bought the right property in that time frame, and you still own it today, you probably had hundreds of thousands of dollars of equity. And that was, obviously right after the crash. There was still a lot of uncertainty, and then it started to pick up. People said, okay, the market is not as bad as it was a few years ago. We can still buy real estate. Real estate's not just going to go down forever. Like I said, it's cyclical. And people made a killing during this time frame if you bought correctly. The challenge we have is we're coming into that time in our normal hot season. So if the end of the summer slows down and we go into a normal fall and winter, which is always slow, we could be looking at 9 to 12 months of what feels like December. Many people who have asked me, what do you do? And I've said, pretend your worst month in your last 24 months is your new average month, which, if you're a real estate professional or investor or even home buyer or seller, you need to prepare. Do you think that applies across the board? If you're an investor or someone in tech, do you need to be planning in the same way? It's not a surprise based on all the layoffs and fundings that have stopped and people's inability to raise money that investors are coming back and say that we used to invest in revenue growth, but because of an impending recession, we want more solid companies so we can invest in EBITDA or net income or at least break even types of companies. So if you've seen recently like Redfin, Compass, they've laid off tons of people because a lot of times they weren't really making a profit. They were just trying to boost revenue to get their valuations up, and profitability was not their main concern, but they've had to really tighten things up. And you've also seen some companies actually go out of business. If you look at Rex, discount brokerage, they just went out of business, or I think they're operating in a very limited capacity. That's no surprise. Pretty much every discount company goes out of business during a downturn if you look at the history of those things. But, it's still a sign. Times are getting a little bit lean right now. So all of these companies that have never justifiably, that's what their investors told them to do, focus on breaking even or making money, are having to pivot their entire strategic plan. And that's what's going to cause some chaos for a while. It's going to shake up the market. I think Warren Buffett said, when the tide goes out, you see who is wearing swim trunks. And a lot of people get exposed in these shifting environments. So this could also be for sellers that are, expecting to get $1 million for their property when they know it's not worth that much. Maybe if they sold it 3 or 4 months ago, yeah, maybe they'd get multiple offers. You're also going to see these investors that were just speculating. Instead of buying properties based on like fundamental, solid, like ARV, like 70% ARV, they were just saying, you know what? We expect the market to go up another 50K. So we're just going to buy this. Hopefully it goes up 50K. But if it doesn't, you potentially could see a lot more foreclosure activity as well. And that's why you need to buy very conservatively. When I purchase properties, I could basically resell them the next day without doing any work and make a pretty significant profit. Or if you're buying a rental property and you're trying to build up your portfolio, make sure the thing is cash flowing. A lot of people got in trouble in 2007 because they were buying properties expecting the market to go up while losing $300, $400, $500 every single month. And that's not a sustainable business model. When the tide goes out, it shows who is wearing swim trunks, but also some people get swept away, so to speak. Do you think we'll lose companies amid what's going on right now? I do think there were companies that were built on poor fundamentals or companies that were built on the understanding of a hot market. Like people who make multiple offer software. They're going to have to pivot because maybe you don't need that going forward. Or people who have buy before you sell offerings. They're going to have to pivot their offerings. And if they can't pivot quick enough, they'll be eliminated. And in addition to Rex, the discount brokerage that was basically founded on, they tried to sue about commissions and just basically sue their way to becoming a profitable company, which is really not a good strategy. And then you had Zillow offers. So I think you're going to see a lot of these companies that just make these iBuyers. They're not profitable, and their business model is very questionable, and you're probably going to see a lot more layoffs from companies like that because Zillow is very smart. And if Zillow is cutting back and basically withdrawing all their offers, I think you're going to see a lot more companies following suit, especially because prices are about to be probably going down a good amount in the next 6 to 12 months. We've also seen an influx of big money with the Open Doors and the Compasses and those kinds of companies that grew thanks to huge investments. Do you think that'll continue? Certain companies have gotten large enough to the point that they have enough revenue and they have enough capital that if they fail, it's solely because they didn't pivot and change quick enough. But most of these big companies, you can already see it in their layoffs and their changing of offerings, that they are preparing for a worst case scenario. I call it apocalypse planning, preparing for the zombies to show up. And in that situation, you have to do something very different. You see these big companies doing that, and they have a lot of big money backing them, and they're most likely not going to want to walk away from that investment. And that actually reminds me of something Sam Zell said when he's evaluating real estate deals. He thinks of, what is the worst case scenario in this deal and what is the best case scenario in this deal. And if the worst case scenario is significantly more likely to happen, but maybe there's like a 5% chance that the best case scenario can happen, then he will walk away from that deal because it's not worth the risk. As an investor, you really have to, keep risk in mind and think about what is the worst case scenario. Do I have to rent this out? Do I have to refinance? Do I have to just sell it as is? Keep that in mind. It's the ones in the middle that worry me. They're going to get acquired, or they're going to get shut down, or they're going to tighten their shoestrings and grind their way through it. You mentioned this idea of apocalypse planning. Talk to me about how you built resilience into your companies. We had a blessing for a long time I thought was a curse. It's that we didn't raise money. And because we didn't raise money, I had to fund the investment. My co-founder, Chris Suarez, and we had to fund the investment into our companies. So any money we lost came out of our own retirement account or our own bank accounts or out of the profits of our other businesses. And I love this so much. And I'll tell you a quick story in a second here. Because of that, we had to run a business that broke even or made a profit. So we went out and raised capital last year. We deposited all that money into our bank account, and we looked at each other and said, why don't we just keep running a profitable business and not use that money unless we absolutely have to, or save it for opportunities to get into business with great products and great companies that run into a tough time in the future. And that is so smart because there's 2 points I want to make here. One is that although it sounds great, if someone gives you a lot of money like venture capital or different investors and things like that, it can be so easy to just run through that money. I remember an investment company, this was actually a while ago. They've since gone out of business, but they were just buying deals. I remember the guy told me, he's like, we'll pretty much buy any deal because we just have to keep our guys busy. So they weren't like, they had so much money that it was like they would just buy anything, and it wasn't built on any fundamentals. Whereas I think if it had been their own money, they would have been much tighter. They would have had much better underwriting standards, and they wouldn't have bought all these crazy deals, and they'd probably still be in business today. And I love this part here where they're just keeping that money, just waiting for opportunities or waiting for a potential downturn. And that's really smart. That's like a Warren Buffett kind of concept right there. Berkshire Hathaway is known for just sitting on like hundreds of millions of dollars of cash, just waiting for the best opportunities. They evaluate everything that's on the market. A lot of times they think it's overpriced. And then once those really good opportunities pop up, like at Warren Buffett's, he's bought banks, Geico, he's in a lot of different industries. But they will be patient. I think Warren Buffett went like 7 years one time without even buying any stocks because he couldn't find like the good fundamentals on it. So this is really smart. They have the backup plan. If everything hits the fan, they have the money to get them through, but they already have a pretty profitable business model. Or if a great opportunity comes up, they can pounce on it, and most people are not going to have cash right now. And that's why it's also important to always try to have like cash reserves, especially, apocalypse planning. You need to have like a treasure war chest, basically, in terms of like lines of credit, cash, anything, because there's going to be deals coming up. There's also going to be potential, the potential recession coming up. He says, so we just set a standard that we will not lose money, and that gives us a little bit of longevity. If I had a company that started off venture funded and my investor said, spend the money, we'll give you more, and when you're done spending that, we'll give you more, I might have been trained into a different mindset and might have thought that would go on forever. I just wasn't lucky enough to raise money early in my venture, so it always came from my own pocket. So I treat every dollar like it's my dollar, even after the minority investment we received. So you're seeing a lot of these other big companies, having to lay off tons of people because their whole business was just propped up on venture capital. There was no like real good fundamentals in terms of their business model. You mentioned layoffs and pivots. Are you going to have to tighten your own belt at all? We are hiring at the moment based on the increase in profit that we make each month. We decided that we are going to have a 10 or 11% EBITDA. So if we can generate revenues above that, we use that additional money to cover our new hires. So they're being very conservative, but still having a growth mindset. Looking forward, what does the future look like for your companies? What exciting things do you have on your plate? I think when the real estate market is good, everyone thinks they're a genius. Every tech company, every real estate brokerage, every real estate agent, including us. But when the market shifts, there are unique opportunities to partner and to help people and companies that wouldn't have been open to it during a hot market. I think what I'm most excited about is the partnerships and the customers that truly are going to need what we offer to survive tough times. And when you help people survive tough times, the good ones tend to stay loyal to you through the next cycle of better times. That's probably what I'm most excited about. talent is more available, tech acquisitions are going to be more available, and our customers, top real estate professionals, are going to be more open and trusting of our brand that we call Place. And what I'd add in here in terms of apocalypse planning, if you're an investor or buyer or seller, is he has multiple streams of income. It's like a very solid foundation. He has like the brokerages, Place, and then also like training companies. So he's, the revenue, the cash flow, it's not built up on just like, hey, give us, $10 million and we'll try to make some company work and we'll blow through all your money. He has solid businesses. And if you're an investor and you're watching this, I think there's a lot to be learned from this. You can get into a couple different businesses. Like you should have your one main core one, but then you can diversify to build up more of like a solid foundation as opposed to just being completely dependent on all your real estate commissions. That's why I tell people, buy multifamily. Maybe you can get into the training industry as well, teaching people how to do things. But you basically need to think of this as like survival. For example, I have cash flow from my multifamily properties, agent income. I do some, some flips as well as like YouTube ad revenue and that type of thing. So agents and investors, you need to like think outside the box. Don't just be completely dependent on your commission. And if you are, you really need to build up that treasure war chest where you can just survive, the next 6 to 12 months, maybe longer. It's going to be tight. If you're a seller, you're going to need to make sure that property looks perfect. Make sure it's painted. Make sure the curb appeals in the top 1% of the 1%. And if you're a buyer, there's going to be some amazing opportunities. I'm looking actively to purchase more properties in terms of multifamilies as well as flips. And I'm starting to see more inventory, more days on market, and, just more potential. So watch this video right here. And if you have any questions, drop them in the comment section below, and I'll see you on the next one.